Welcome to video lectures on chapter 14. In chapter 12 we studied financial statements, balance sheet, income statement, cash flow statement. Chapter 13 we saw what do investors look for when you provide your financial statement. And now in chapter 14 the question is, how does the transaction, there will be many transactions that the firm goes through, and here we are focusing on how does the transaction influence the three financial statements. It's an important concept in traditional accounting classes. This is where accounting will begin. We are coming to it at the end. We have done everything in a different way. The four accounting concepts: transaction analysis, debits and credits. You cannot graduate an accounting class without hearing that. Accounting principles, financial statements. Let's start with transaction analysis. So we are talking about how does the various transactions finally translate into financial statement. The essence is the transaction analysis. You're going to get a taste of it. What is the difference between GAAP and IFRS? Right? So GAAP stands for Generally Accepted Accounting Principles that US companies must follow in preparing their financial statements to make the statements believable and comparable. You see, for an investor, you are going to an investor. Many other companies are going to go to the same investor. So one of his trouble is, why should he believe your financial statements? You're trying to attract his funds. So are everybody else. So every one of you have incentives to spin a positive story. So the investor is naturally going to be suspicious. Another problem he has is how to compare your statements. If you call something revenues and another company have their own definition of revenues, then comparability becomes difficult. Now this is why we have GAAP, Generally Accepted Accounting Principles, that firms have to follow so then the investors can believe and compare. Now over time we had something called IFRS, which stands for International Financial Reporting Standards, that more and more companies are following in addition to their local financial reporting, particularly if they want to go to international investors, right? To make comparisons with companies even around the world easier. Because otherwise you picture, okay, all the US companies followed GAAP, but there is a Malaysian company that is being traded in New York Stock Exchange, but they are preparing things according to the Malaysian standards, and then again a US investor will get confused, or it's going to become difficult for him to compare. So that's why IFRS emerged. And so if some company in Malaysia wants to come to US, then they have to prepare according to IFRS as well. So if US companies also prepared according to IFRS, so then this investor that's comparing a Malaysian company with US company can look at the financial statements prepared according to IFRS and makes his comparisons. Now both IFRS and GAAP require that firms follow a double entry when translating transactions into financial statements. What is a double entry? According to GAAP and IFRS, at any point in time the source of funds must balance with the use of funds. Right? And this is the idea of a balance sheet. Right? And at any point in time, the source of funds. Now what are the source of funds? We have liabilities and owner's equity. Creditors by giving time to pay, that's current liability, and giving loans on a long-term basis to earn interest, that's long-term liabilities. Owners contribute. They initially contribute capital, like the 20,000 we did, then later they retain earnings. So these are the source of funds. And what are these funds doing? They are invested in assets. Current assets like inventories and accounts receivable and cash, and long-term assets like equipment make up the use of funds. Now what double entry is saying is, every transaction calls for a double entry. What do we mean by double entry? Change in at least two of the above balance sheet accounts in such a way that source of funds remains balanced with use of funds, right? Because otherwise, if you made an entry, a single entry, then things won't balance anymore. So because you can't go and change any one account in the balance sheet, you've got to make at least two accounts, and you should change them in such a way the balance is always intact. What are the major transactions during the startup phase? Right? Financing activities and then investment activities. Some of them are capitalized, they are treated as long-term assets. Those that doesn't have a resale value are expensed. So it is good for you to know these activities, because if you're going to start your business, this is kind of the order in which you would go. So then you come to operational activities. Well, what are the major transactions? Well, some production activities, buying the t-shirts and printing the logos, selling activities through Marshall Street Store, online sales, event day sales, distribution activities, online sales, they need to be shipped, cash collection activities, then servicing activities. If anything goes wrong, if a t-shirt is shipped back and you got to honor, and course administrative activities and interest related activities. Let's see this in our sample plan. So this is also good for you, like when you start your business, one of the first activity is financing activities. You have to have funds. So in this case, owners contributed capital to the business, creditors loan money. The investors put 20,000, the three sources gave so much money. Then what do you do with this money? You go and invest them. Invest in long-term assets, the logo printing machine and the furniture. But there are also other startup expenses that cannot be resold, so must be expensed. So that's a 54,500. So that's the startup phase. Then you go to operational phase, which is going to repeat itself. And so here are the typical costs you are going to incur. You paid for variable operational costs. Right? This is like paying your Mexican supplier and packaging materials. They are variable costs. And paid for fixed operational costs like rent and insurance. Then you offer your products and services, you collect money, then you pay off interest expense. Tax we didn't have to pay, but if you have to pay, you pay that. Then if you had extra money, you distribute dividends, right? Then you pay off debts, right? And then if you still have money, you pay off owner salary and owner resource rent, right? So we come here, and now let's do an example. See, one of the financing activity, owners contributing 3,200. So it's a first transaction. How does double entry work here? Remember, you can't do a single entry. You say, okay, balance sheet item, owners contributed. What is this? Oh, this is contributed capital. So contributed capital increases. But that's a single entry. So there must be a corresponding entry to keep the balance. You say, well, what is this 3,200 doing? It goes into your checking account. That means your cash, your use of funds is going up. It balances. Then you go to an investment activity, purchasing an equipment for 1,500. Okay, so when you purchase an equipment for 1,500, certainly your cash is coming down, so you decrease cash. But then what else is going on? You said, okay, now you have a long-term asset. So you increase your long-term asset. You see the double entry. But you will see in a minute, they are all done in a way that the balance sheet remains balanced. Spending $1,700 on initial expenses. Things like legal fees. So again, cash is decreasing. You're paying it. Then you would see the corresponding entry is, it is a cost you are incurring that it is gone. So it's going to really bring your earnings down, which finally is going to bring your retained earnings down. So let's see how they work. So here are the entries for the first transaction, second transaction, third transaction. Before that, here are the balance sheet. Sources of funds: creditors give money, current liabilities, long time to pay, and for interest making purposes they give. Then owners give money through contributed capital, retained earnings. Then the use of funds is you have current assets, cash is one of them, and long term assets. So initially there was nothing, 0, 0, right? Then the first transaction, owners contributed 3,200, so your contributed capital goes up and cash goes up. So at this point, total assets would be 3,200, total liabilities plus owner's equity 3,200, it's in balance. Second, you purchased, you invested in long-term assets. So your cash is coming down now, you don't have 3,200 anymore. But what's the corresponding entry? Hey, now you have long-term assets. So you would see the total then is 1,700 in cash, 1,500 in long-term assets, 3,200, and contributed capital 3,200. Then the third transaction, when they spend 1,700, again cash come down 1,700. So now your cash balance is 0. Right? But what's the corresponding entry? It is not. There is no resale value, so we cannot increase this. Instead we say, well, this money is gone. So unless you get a corresponding revenue, this is going to bring your earnings down and finally retained earnings down. So that's why we put the corresponding entry here. So now if you add up everything, you have 0 cash, then you have 1,500 in long-term assets. So total use of funds is 1,500. No current liability, no long-term liability. Owners contributed 1,300, and then they have lost 1,700 of it. So 1,500 is their owner's equity now, and it balances. So this is the double entry and the transaction analysis. So you can kind of see the double entry, it can be the same sign on both sides. So you increase source of funds and use of funds, or it can have opposing signs on the same side. So one use of funds came down, cash, another one went up. So in this case you can have negative signs, but opposing side, same sign both sides, opposing signs same side. Okay, let's stop and think. What is the double entry for cash spent on initial expense? Right, we kind of did that now. Decreasing earnings and increase cash. Cash spent on initial expense. Increase earnings and decrease cash. Decrease both earnings and cash. Increase both earnings and cash. Take a minute and see whether you can spot the entry. Correct answer is C, because cash spent. So that means your checking account balance is going to come down. So you got to decrease cash. Then the second entry you say, cash spent on what? Long-term asset? No, spent on initial expense. So that means it's a loss. It's eating your earnings. So earnings is going to come down, right? So decrease both earnings and cash. Right? So note, the moment you said cash spent, it can't be increased cash, right? And so D is out, A is out, right? It's decreased cash. But then on initial expense, so it is an expense, so it can't increase earnings, it has to decrease earnings. Okay. Let's talk about debits and credits. This is what a typical accounting class would begin with this, and this is one reason why students lose interest in accounting, because it seems so confusing, this debits and credits convention. Usually we kept it till the very end, and now I'm going to show you what they are, and it's not rocket science. What are debits and credits? Okay. Credit indicates an inflow of funds. and debit and outflow of funds in an organization. If you think of it like, normally we think credit is bad, but really credit, when we make a credit entry, that is reflecting that funds are coming into the firm, right? And that's kind of a good thing from a funds point of view. Debit indicates funds are flowing out of a firm, right? And that, from a funds point of view, kind of a bad news. So when we use a credit card, we normally think it's bad, but what is happening is when you use a credit card, the credit card company is giving you funds. Right? When you use debit, really the money in your checking account is going to leave you. Right? So credit card is bringing you funds, debit card is taking funds away from you. Right? So that's the idea. So credit indicates an inflow of funds, debit an outflow of funds. Accordingly, increase in funds through liabilities. So when you buy some things on credit, or when you borrow, when you take a loan from your bank, they are both bringing you funds. So they would be considered a credit. Or even when owners give money, the contributed capital, the 3,200, it's a credit because funds are coming. And decrease in funds through investment in an asset, like that $1,500 when we purchased, when we said there is a long-term asset, we are increasing it. Now that would be a debit because that's causing funds to leave the firm. Okay. As such, revenues. Remember, revenues is owners give money for you to make earnings, and revenues increases earnings. Now that is a credit because it's good news, funds are coming in. Similarly, decrease in source of funds, right, is a debit. So when you get rid of an asset, right, and money is coming in, so that's a credit, right? But whereas if you decrease your liabilities, that means you're paying off your debt, right? Then funds are going. It's a debit, right? So let me see. Decrease in source of funds. So that is decrease in asset, right? Is a debit because funds are leaving, right? And decrease in, so let me get this, decrease in source of funds, sorry. So this is like an accounts payable, and you are paying it off. That means funds are leaving. It's a debit. When an increase in accounts payable means funds are coming, it's a credit. When you're paying off your accounts payable, funds are leaving, it's debit. And decrease in assets, you're kind of selling an asset, right? So that means money is going to come, it's a credit. As such, expenses, those initial expenses, or when you distribute dividends, funds are leaving, right? So it's a debit. Okay, here's the good news. How important it is to remember the debit credit rules. One need not remember the debit credit conventions. Typically in an accounting class, they kind of scare students to death. All you need to do is understand the transaction analysis. Didn't we do that for the 3 transactions? That made a lot of sense. Transaction analysis predicts the impact of transactions on the balance sheet accounts, namely assets, liabilities, contributed capital, retained earnings. And that's much easier to understand, much more intuitive. That's all you need to know, right? Stop and think. Which of the following is not a credit? This credit is funds coming in. So which of the following is not bringing funds in? Increase in accounts payable, increase in long-term liabilities, earning revenues, distributing dividends, Which of this would not be a credit? The correct answer is D, because when you distribute dividends, funds are leaving. When funds are leaving, it's a debit. Okay, let's go to some specific accounting principles. What are some important principles that govern this double entry process? Conservatism principle. This is part of what makes IFRS and GAAP. When in doubt as to what is the value of your asset, be conservative in valuing assets and reporting earnings, because outsiders, the investors, are paying attention to your worth, right? Paying attention to your earnings, right? So don't overstate the case and then later get into investors getting upset and suing you. So when in doubt, be conservative. Don't overvalue. Be safe. And don't over-report earnings. Accrual accounting, we studied this before, an accounting method that measures the economic income of a company by recognizing economic events that leads to potential cash inflows. And revenue recognition principle tells you that you must recognize revenues only after earning it, and outflows. The expenses, the matching principle says it doesn't matter when you pay. If you incurred an expense, you have to incur that cost, and that's the matching principle talks about expenses. The whole thing is accrual accounting. Objectivity principles. When valuing expenses and assets, use objective and verifiable numbers, right? So don't go with what the management says. If they say the asset is worth so much, well, show the invoice when you purchase the asset, because that number is verifiable. The market value of it may have changed, but you don't want to go and value it at what they claim to be the market price, because that's not an objective number, right? Even though this leads to sometimes a value of your historical value of your asset is a bit of an outdated number, but that's the sacrifice we make, because we want numbers to be objective and verifiable. Why these accounting principles require some adjusting entries be made at the end of a period? You would see that there are some adjusting entries needed at the end of the period before you prepare financial statements. Why? During the period, some revenues may have been earned and expenses may have been incurred without any immediate cash implications. Normally when cash is leaving, we are sensitive to that. Same is the case with the firm. But sometimes that you ship something, you got an acknowledgement from the person who is buying from you, and so now you have earned the revenues, but no cash change hands, so we may tend to not report that transaction. The lack of cash implication causes firms to fail to recognize these economic events in a timely manner. Also, it is more convenient to delay the recognition of recurring expenses at the end of the period. Sales are taking place every day, almost every hour. You don't want to make an entry every time. You keep all of them and you make an entry at the end. This is why adjusting entries must be made before preparing the financial statements of a period. So let's look at some adjusting entries here. You would see at the end, here are two adjusting entries. Depreciation expense. See, we didn't write a bill for anyone. It's just the assets lost value, and so we got to recognize that loss in value. Similarly, you didn't pay owners, right? Because they said, okay, you don't have to pay us, but then that must be recognized. And that is the salary payable, and that will be part of an adjusting entry. Okay, so let's come. Okay, let's stop and think. Which of the following principles contribute to accrual accounting? Revenue recognition principle, matching principle, conservatism principle, all of the above. Okay, correct answer is all of the above, because revenue recognition principle asks you to accrue revenues, whether cash came in or not. Similarly, matching principle says accrue expenses the moment you incurred it. Conservatism says be safe, right? And don't overestimate assets and earnings. So all of the above principles that contribute to accrual accounting. Okay, finally, how do we go from transaction analysis to financial statements, right? What is the connection between transaction analysis and the balance sheet? So let's come back here and see what do we do with these transactions. So here all these transactions, then we do similar to for that 3 entries that we did. So now we have altogether 15 entries, and you can see here are the entries. So first, for example, when owners contributed $20,000, you would see, if you look at transaction 1, and that's 20,000 contributed capital increases and 20,000 cash increases. The only difference is cash, we are going to kind of separate it from cash flow from financing, investments and operations. And then when we borrowed money, it's a long-term liability increases, then cash flow from cash increases, specifically cash flow from financing. Then when we purchased assets, you see long-term assets increases and cash decreases, but this is cash flow from investments. Then when we spent on startup expenses, it's that one we put it under operations, but the other side is earnings comes down. Then here is our variable cost, cash flow from operations comes down, earnings comes down. Here is our fixed cost, cash flow from operations come down, earnings come. Here is the good news, sales is taking place and money is coming. Here you are paying for interest, right? And then here we are paying off a debt. So cash flow from financing, right, and comes down. And here you see our long-term liabilities come down. And so now we come and say, what can we learn from that? What is the connection between transaction analysis and the balance sheet? Balance sheet essentially reports the period end balances in each of the accounts in the transaction analysis. If the transaction was done right, the source of funds must balance with the use of funds after each transaction. Okay, so what are we saying? If you look at here, all that the balance sheet does is it looks at your cash balance. Okay, we have 69,387. At the end, other current assets 0, and you have long-term assets after the depreciation is so much, your total assets so much, and here is your current liabilities. This is what you had to pay to the owners. This is your long-term liabilities. You borrowed so much, you paid this off, then contributed capital so much, and here lots of entries on earnings. So here is your final earnings number, and then you add all this. You see, if we did this right, use of funds and source of funds must be the same. So all we are doing is we translate all of that into your balance sheet. It's listed here, the end balances. Similarly, we come, given the many transactions that relate to cash receipts and payments, the cash accounts tend to receive the most entries during the transaction analysis. And given the many economically significant events that relate to the performance of a company, then retained earnings account tends to receive the second most entries. So then what these GAAP and IFRS require, so both GAAP and IFRS require that firms summarize entries made in the cash and retained earnings account separately as a cash flow and income statement, right? And they want cash flow to be separated into cash flows from operations, investment and financing, and earnings to separate revenues and expenses. So if you see, that's basically what's going on here. So if you first look at your cash balance, while balance sheet reported this balance 69,387, there is lot of entries made here. And also we kept these things separate, so a cash flow statement is basically going to say, hey, our cash flow from operations is so much, from investments is so much, and from financing is so much. And from operations, you just go here and you list them. You ask, well, what is this? This is for your startup expenses, and this is your variable cost, this is your fixed cost, this is the money came in. So we take each of these things and you would see that's your cash flow statement. Each of that, this is income statement. Then you come down, here is your cash flow statement. Cash flow from operations, and everything on that row is listed here. Then here is your cash flow from investments, cash flow from financing. Then you add the 3, and that's your ending cash. Now if you compare this to our chapter 12, right? If you look at the chapter 12 ending cash flow, see, you have that 69,387, and that's what we are getting here too, right? 69,387. Right? And if you look at your balance sheet, we have your first year end balance is 108,867, and that's what we are getting here when we listed everything. You see, we have 108,867. So we do the same thing for income statement also. Many entries made here. So IFRS and GAAP requires, it's good not just to report this final earnings number, but to tell what happened here. So you list all of this. Remember, this is potential cash inflow, incurred and potential cash inflow earned and potential cash outflow incurred. So you take all of this and you list them, and that's your income statement. So here is your income statement. You took everything in that retained earnings column and you list it here. And finally you see net income is negative 29,733, and that's what you have here. Here negative 29,733. So you see that how we go from transaction analysis, and it's pretty easy to understand. We just make double entries. We don't need to muck around with debit and credit, and so once you understand transaction, it's even better because you can straight away predict the impact on the financial statements. Okay, so let's take the quiz. Which accounts receive the most entries during transaction analysis? Cash, long-term assets, earnings, dividends. The correct answer is cash, and because there's cash flow from operations, financing, investments, and the second most is earnings. Okay. And that's why they require separate statements. So think of cash flow statement and earnings as part of the mother statement, which is the balance sheet. Earnings statement, or the net income or income statement, is just explaining the final number in the balance sheet reported as your earnings. And same thing, your cash balance is being explained through your cash flow statement. Okay, hope that is helpful.